What's up, everybody? Welcome to the Student Loan Planner podcast. Today, you've got myself, Megan, Sim, and Sam. We've got the SMS crew today. So welcome, ladies.
Hey, what it do?
Hey guys.
Also the Philly crew. Y'all are the Philly folks.
The Philly Jewish ladies.
We'll try to prevent that from coming out too much in this content.
Unavoidable. But we're looking forward to our topic today. We're going to talk a lot about Roth IRAs. We're going to talk about some of the problems that can come about with Roth IRAs or backdoor Roths. So some fun stuff, guys, but very relevant to a lot of folks, I think, that listen to this podcast because Roth IRAs are great. They're like a highly recommended vehicle to save for retirement within. And we, a lot of times for student loan purposes, talk about filing taxes separately, or our income level with the amount of, with your profession might prevent you from being able to contribute directly to a Roth. So in passing, we've had webinars. We have actually a free webinar series going on right now. So look out to our newsletter about when those are. But we've had some series on taxes. We had an episode on Roth IRA, but this topic always blows up our chat with questions about, wait a second, I didn't realize that XYZ. So like there's a lot that goes into this conversation today, but I'm really looking forward to breaking it down with you ladies again today. So let's maybe kick it off. What do you want to start with?
Well, let me tell you how much I love Roth IRAs, almost as much as I love HSAs, which will be a different topic. Okay, Roth IRA, second love after my husband. What is a Roth? So a Roth is a way to build up this bucket of after-tax money for retirement. So there's nothing special about it today. You don't get like a tax deduction or anything, but the hope is that, you have a well-diversified portfolio, right? Blah, blah, blah. There's no guarantees with anything, but theoretically it should grow. And none of that growth is taxable to you. And I'm just like, that blows my mind because I hate paying taxes and I don't know what the future is going to hold. So I just love the concept of there being money that I don't have to worry about. Like, hey, am I going to have to pay taxes on it? And I can live off of that.
Yeah, absolutely. And I think, I think the Roth IRA, especially when you're first getting into saving and investing, there's really just two conditions you're presented with, right? To get that tax-free earnings, you'd really just have to be 59 and a half and, it's been 5 years since your first funding of that, right? And that's really what all you're taught about the Roth IRA. But I think today we're here to focus too on more about what happens when we get more into the weeds of like how different circumstances can like affect whether you can make a Roth IRA contribution, or if you make a contribution when you shouldn't, what are your options to kind of for resolution there?
Mm-hmm. If that, I feel like a lot of people don't even know about the 5-year rule, especially with conversions. So we'll have to break that down a little bit for folks today too. So,
Facts.
but yeah, let's jump in. So Roth IRA was started in, I think I said this on the webinar, now I can't remember, sometime in the 90s, but it got really popular, I think in like 2006, 2007, when employer 401ks were able to add a Roth option. And so everybody was talking about Roths at that point. I literally remember like dads and uncles and moms like at school, like talking about Roth IRAs, which is kind of funny.
Fun fact, did you know that the Roth is named after William Roth? A former senator from Delaware.
Yes, it is not an acronym.
Yes.
That's nice.
And so I actually like to, because like we hear Roth IRA so much, so that like people seem like this is like I want to just not to go off course here, but to talk about how Roth itself is a characteristic, right? It was named after a senator. And so an account, like an IRA, individual retirement account, is separate, right? The contribution is the characteristic in a sense of being a Roth, right? After tax-free money. So you can have a Roth 403B, you can have a Roth 401k, right? And it can be in the same account. So I think sometimes getting used to talking about Roth itself, but today we're going to be focused more primarily on how Roths operate in an IRA.
Mm-hmm. Yep. So max this year for 2024 is 7,000, right? For how much we can contribute, plus another 1,000 if you're over 50 years old. That's called a catch-up contribution. There are income limits to being able to contribute to a Roth. So if we're single, there's a phase out period between 146,000 and 161,000. So it's still a pretty, large income, but we work with a lot of folks who after residency or after training, like we're making quite a bit more than that. So even the single phase out limits are definitely relevant to pay attention to early on in your career. Married filing jointly, the phase out is larger, so 230,000 to 240,000. That just means if you make somewhere in between 230 and 240, a percentage of, you have to do this little math calculation on how much you can actually contribute. It prorates it between that range, but after 240,000, we cannot contribute directly. And married filing separate is it's really bad. So if we file separately, the phase out is $0 to $10,000. So if you're making more than $10,000 and you're filing taxes separately, probably for student loan purposes, you are not going to be able to directly contribute to a Roth, right? So a lot of times when we've dropped that knowledge, that's when our chat blows up. Like, what? So let's break that down more.
Enough, like 10,000, that like the first, especially for filing separately as opposed to filing jointly or single, right? That does not keep up with inflation at all. That's never adjusted. I feel like it's been 10,000 for years.
A long time, yeah.
Separately. And I don't know, I always say to clients, I don't know about you guys, but is that, hey, if you do qualify to make this when you're filing separately, you probably in most cases should not be contributing to a Roth IRA anyway, because you should be using that money elsewhere in a sense, right? But like most of our population are not in a case where they're going to be able to qualify through that right away, like to make a direct contribution.
So this is where the backdoor Roth comes in. So people talk about backdoor Roth. You've probably heard it or read it on a blog somewhere. So do you want to break down the backdoor feature or the backdoor characteristics, Sim?
Yes. So first of all, big pet peeve is when people talk about backdoor as like an account type, like I have to open a backdoor Roth. Big pet peeve, which by the way means I probably have a very privileged life if that's what, keeps me up at night. Backdoor refers to a process. So it is a thing that you do. It is a backdoor way of contributing into the Roth. So if we can't put money directly into the Roth, we can still get the money there. And this is totally legal. It just means our money has to take a little detour first. So normally the way you would want to do it, the easy way that makes sense is that, you have money in your bank account, your checking, and you make a transfer into the Roth. And so what we do instead is we make a transfer to a different account first. And that account is the traditional IRA, the OG. So the money goes into the traditional IRA. You wait maybe like a couple of business days, just let the money kind of clear your bank account. And then you initiate a transfer from that traditional IRA into the Roth. So instead of making one transfer, you are making two, and the money ends up where we want it to be.
Sounds silly, right? But it's the way to get around it. And
it's
what
so
happens?
Stupid.
Yeah,
it's so stupid because they know everyone is doing this. It's like, get rid of the AGI limitations.
I know. Yeah. And it's
opening Pandora's box there.
It sounds silly to like explain too. So like when we're explaining this to clients, they're like, okay, why do I have to do this? But it's just the get around way to be able to make a contribution. So, first, if you're thinking like, this sounds like a lot, I don't even know if I want to entertain this anymore. You don't have to. If your employer provides a Roth 401k or 403b, you can start contributing to the employer plan without any limitations due to your income or your filing status. So start there if you really want to contribute to a Roth asset. Now, the con to doing a Roth contribution to your employer account, the downside is that it's not going to be a pre-tax deduction. So if you're, trying to get your adjusted gross income as low as possible for student loan purposes, it's not going to help you out there. But if you really wanted to contribute to a Roth asset and you want it to be as easy as possible, then maybe look at your employer account first.
For a lot of folks, I'm a big fan for retirement planning of what we call a 3-bucket strategy. So I personally think that hassle is worth it. I guess that's easy for me to say because, I do these for folks and I've done it myself. But the 3-bucket strategy refers to having 3 buckets of money to pull from in your retirement. So pre-tax money, after-tax money, and taxable money. And so I think if you don't have the Roth option at your job, it is actually very difficult to get after-tax money into your portfolio, which is why I so covet this backdoor Roth process and that it exists for folks.
And also just to talk about, to emphasize what Megan said, like you could always contribute to Roth, but at times we're meeting with people who need to do that pre-tax contribution or they're maxing out that pre-tax contribution to the best they can to their plan limits, that they are kind of forced to go to the backdoor Roth if they want to do more just saving for retirement in a sense too. But there's also certain flexibilities that you do get with a Roth IRA. It's not, we're going to get into this, it's not all just about getting the money into the Roth IRA in a way that allows you to have it, but also investing it in a way that is flexible for you.
So let's quickly talk about, like, what if you're listening to this and you're thinking, oh shoot, I did make a direct contribution to Roth this past year for 2023, but I know I'm filing separately for my 2023 tax return. That was the recommendation for student loan purposes, or, so you're realizing, man, I shouldn't have made that contribution. There's a couple steps you can take to correct it, and you'd want to do it as soon as possible to avoid additional taxes or fees on that improper contribution. So what you could do first is call the custodian that you made that contribution to. So where is your Roth IRA? Call that custodian and ask them if you can reclassify that contribution or recharacterize that contribution, whatever you contributed last year, from a Roth contribution to an IRA contribution. Now, if you don't already have an IRA open with that custodian, you'll have to go ahead and open up an IRA as well, which is fine. They could probably help you with that over the phone too, or you could do that really quickly online. So they'll recharacterize that contribution. They'll pretty much pretend like you made that directly to the IRA instead of the Roth. That will get you back in good graces with that contribution going directly to IRA first. And then what you could do is you can then immediately convert that back to the Roth, because then if you contributed it to the IRA, it's likely not going to be deductible, probably because of either income or filing separately. So you can then completely convert what you had just reclassified from the IRA, convert that into the Roth IRA, and basically you achieve the same result of what you were trying to do before, but you've made it kosher with the IRS. Is there any holes you want to poke in that, guys?
Well, the faster to better, the better between those steps too. It's not the end of this world if you don't, but I think a lot of people forgot that there used to be a time limit of when you did a recharacterization and then convert it to a Roth. But that was more because you used to be able to recharacterize Roth conversions, right? And they took that away 2018, I believe. Don't quote me. But now there is, sometimes you can do it depending on the custodian, same day or next day, right? So the reason why you want to do that is because now that it is a non-deductible contribution, or for most cases, it's going to be a non-deductible contribution that you recharacterize it back to, because generally for most people, if you can't contribute to a Roth IRA, you at that point probably can't contribute to a traditional IRA, probably there, asterisk. That when you want to hold, like, the longer you wait, and depending on how it's invested, right, especially with if it, even if it's in a money market, interest rates are better right now, so it could be earnings and interest.
5% in a money market.
Hey,
like, we've come so far since July 2023. But yes, I think that is kind of something you have to be aware of, is like, what Megan just went over is kind of like the recharacterization issue, right, of getting it done before a timely tax season. But then now we have the general timing issue that happens when you have a non-deductible contribution in a traditional IRA, and then need to timely convert it to the Roth.
Yeah, because then if there's any growth, you're going to pay taxes on their growth, which granted might not be a lot, but you can use that's Chipotle money down the road.
Taco Bell. What are you talking about?
I'll fight you offline.
You do a lot of damage of $11. Taco Bell. Just saying.
The other thing to know about is, what if we get this question a lot. Well, can I just ignore the problem? Can I just leave it? Well, you will have to pay a 6% penalty, right, for every year that it's there until it is corrected. Sam, you want to correct any of that? Sam's like our tax expert here.
No, but no, you're right. You're right there on the 6%. It's more just like you want to do it before your tax deadline. And even if you filed your taxes already, or you miss the deadline, it still doesn't hurt to amend and do 1040X and do your recharacterization. So even if you don't just throw in the towel and be like, this is my life now.
Get it corrected, because then you'll avoid the 6% fee plus the tax implications, which don't sound like a lot right now, but over time, if you just let it sit unattended, that would shake out to be quite a bit of a penalty in the future.
6% is more than what you can get in a high yield savings account right now. So that's a real cost.
Even if you refer a friend.
Yeah.
Which is where you get that extra half these days.
Yeah. And if this recharacterization also seems a little confusing or overwhelming, the other thing you can simply do is just take the money back out. You can take it out as kind of an oopsie. I didn't mean to contribute. You can take it out, take the tax hit on whatever grew on that amount, and then be done with it. Put those funds elsewhere. So there's some options on how to fix it. Let's jump in to, what do we want to go to next, ladies?
My favorite issue with the pro rata rule.
Yes.
The doozy. Okay, let's talk about pro rata and let's break it down to try to explain how this could affect folks who have IRA money laying around somewhere.
So when we did this presentation, we called the pro rata rule a home wrecker in honor of being, you know, one of the two Jewish Philly ladies. Today, I'm going to refer to the pro rata rule as a schmagegi. So the pro rata rule is a real schmagegi. What does this mean? This is referring to when you're trying to do a backdoor Roth, you're trying to do all the right things, and you happen to have money sitting in pre-tax IRAs. So maybe, for example, you had a 401k at one point and you moved it and now it's in a rollover IRA. Maybe at one point you had a side hustle and you opened a SEP IRA, or you have a simple IRA. So these are all accounts that have pre-tax money. So the pro rata rule is a really specific problem that happens when you are doing a backdoor Roth conversion and you have money sitting in those accounts. Basically, what the IRS does, because they have nothing better to do with their time, is they're going to treat all of these IRAs as one big IRA. And then they're going to tax you on a percentage of that conversion. So in other words, if you have a really big, you know, IRA, like they're looking at the total and it's like mostly pre-tax, then the bulk of your conversion is going to be taxable. So that's why they call it pro rata, because they're prorating it.
Yep. And to break that down a little bit further, like why this matters is when you're doing a backdoor Roth contribution, you're not expecting an additional tax bill for doing this, right? Because you already paid taxes on the money that you're putting into this account. And, you know, you do the backdoor conversion, you have money sitting in Roth, but you didn't realize, oh, you know, this pro rata issue. Come tax time, you are going to be taxed. There's going to be an additional tax that you're going to have to pay because the IRS doesn't want you to cherry pick what you're converting. That's basically what this comes down to, is they want you to basically pay taxes on a pro rata portion or proportionate portion of how much IRA money you still have outstanding compared to what you're converting. So this is sometimes a surprise for folks, and a lot of times folks don't understand why they're getting taxed a little extra each year for doing this, and this is why. So let's talk about some ways we can fix it.
Well, just for some more context too,
Yeah.
with these IRAs that you have, like the simple, like all these pre-tax ones, right? You do pay taxes on it eventually. It's just that usually you're going to not pay tax until like 72 and a half, right? You're taking what's called a required minimum distribution, RMD. So that's kind of, for most people, the win, because you're kind of playing the tax bracket game and you're thinking, okay, in retirement, I'm probably going to be in a lower tax bracket, maybe. And so my tax rate at that time is going to be better. If you do end up paying taxes now because of this pro rata rule, you have to keep track of that too. Because if you don't keep track of that, no one else is going to do it. Not your CPA, not the IRS. It's up to you. Because if you don't keep track of that tax, you're going to pay it again when you're 72 and a half.
Like we're talking about probably one of the most important tax implications to be aware of when it comes to a Roth IRA and the backdoor, right? The pro rata rule. And I would say that's where we see most mistakes happen over time, because not of lack of awareness or lack of, if you're working with a practitioner, like lack of competency. Because like when you report a Roth IRA conversion there's an IRS form, it's called 8606, right? There is a pro rata calculation made. So, right, like kind of going back to what Sim says, right? The numerator is going to be the amount converted, right? The denominator is the total amount of all of those accounts, traditional, rollover, SEP, and simple IRAs. Of course, not employer sponsored plans like 401ks or 403bs. But you're going to report these contributions on your tax form. And that's where the form 8606 goes. It goes with your tax form. And so you report the conversion, but you also report the non-deductible contribution on that form. And so I think Megan was just hinting right at like, what are mistakes to be aware of like, how do you fix this? So we're going to get into more options of like, but one of the kind of options is that, you know, you need to kind of zero out those accounts in the same year that you make the, when you do the backdoor Roth. For example, like if you were trying to do this for the tax year 2023, you would have zeroed out all of those simple steps, traditionals. No, you didn't zero it out by necessarily just like walking out with all the money of the bank account. You could do that. I'm not recommending that necessarily, but maybe you zeroed it out, maybe you rolled it into your employer's plan, or if you're a business owner, maybe your solo 401k. That way it's kind of part of that excluded amount. And so, but what happens if you didn't do that, right? You technically what should you do now? It really depends. And that's where I think we're going to get into a little bit more. But one thing you could do is, what happens if you're like, all right, I am not prepared to pull out my entire retirement savings of pre-tax dollars right now. I would rather roll that over, but the year's over. It's March 2024. What can I do? You can do it this year. It will just make, and this could be the move for you. It's just kind of knowing how to report this, right? So for example, right, if you made your 2023 IRA contribution, right, in April of this year or this month, right, instead of reporting both, and then also did a conversion, right, instead of reporting both the contribution and the conversion on your 2023 taxes, you would only report the contribution there, right? Mm-hmm. The conversion would be reported on the taxes for the year you did the conversion. So this would happen on your 2024 tax return, which is going to be due next year, April 2025. Mm-hmm. So your 2023 IRS form 8606 becomes a little simpler, right? But your 2024 IRS form 8606 becomes a little bit more complicated. But if you've zeroed out those other accounts going forward and beyond, it should be golden.
I just want to comment on what you said, because I think a lot of people don't know this, what you just said about April 15th. You can make a contribution for 2023 still until April 15th, your tax filing deadline. So it's not by calendar year, just FYI, if you didn't catch that. And my takeaway, Sam, is that I need to get a tattoo that says 8606, just so I remember.
How many times during tax season do I say this a day? I feel like, what is your 8606?
I'm just going to get like 8606, like, yeah, like, knuckles like that.
Both traditional and IRAs, Roth IRAs are, they're the ones that the benefit of having until, like Sim said, the tax deadline to make a previous year contribution while in the current year. Mm-hmm. The reason why, that's why actually for a lot of our clients who we encourage to file separately, they don't even sometimes begin the process until later on, or like they're always like a year behind here, or that if you can contribute to a Roth IRA directly, you typically don't end up doing it until this time of year anyway, because you don't know what your income might look like.
Yeah. Yeah, it is tricky because you have to kind of project what you think your income's going to be, and if you're going to be under the limit, or, if we find out, oh, we're going to be filing separately towards the end of the year. Like, so all that to say, like, we can make the adjustments in different tax years. There could be fixes that happen in one year and then the next year, and they'll be reported on this form. And if we looked at them like collectively, like they should not wash each other out. That's maybe not the best way to say it, but like they make sense. They reconcile. That's a good way to put it. Like the two tax years can reconcile if it's done correctly later. So don't panic if it's not done within the same year. It'll just, take maybe another year for it to show back up as reconciled.
If you're picking up on a theme from today, is don't ignore the problem. It can be resolved right. in one of a few ways. And even though it's going to cause a short-term inconvenience to you, it's worth it.
Yes. Yeah. Short-term inconvenience if we didn't know these things. So, let's talk about a couple ways that we can fix having existing traditional IRA money outstanding, right? Because for most people, the answer is not going to be going ahead and taking all that money out, right? Because if we take money out of a traditional IRA, it was pre-tax money. So now we have to pay taxes on it in the year it's taken out. And if you're under 59 and a half years old, you're going to be paying a 10% penalty unless there was some kind of qualifying event, which for probably this reason, it's not a qualifying event. So that is
can I comment on that? I'm going to be contrarian. Yeah. I think because I love after tax money as much as I do, I think if it's not going to be a huge tax hit, I think sometimes it makes sense just do the conversion, get that money, so it's after tax now. For example, I work with a lot of physicians, and so maybe it's someone who just finished residency and next year you're going to be an attending. So you're probably in the lowest tax bracket that you will ever be in again, probably until you retire. So I think why not make the conversion? Yeah, you'll pay some taxes on it. And now for the next like 20 or 30 years, it's going to grow after tax.
Yeah.
Well, I think there's two options there, right? There's the pull everything out in cash and walk away, which I think is not ideal, right?
Right.
That's the penalty.
And then the second one is to convert the entire balance. But I think the biggest question we all get is kind of like, and I don't even know if we have the answer today, is what is the under over threshold of how much someone should consider to do this, right? What is the amount of count, right? And this is going to be very specific and personal to each
It always
listener.
depends, right? Because it does definitely depend on what your income was for the year when you're looking at maybe doing a conversion. And it could definitely make sense. And if you're on board with having more Roth money, like, and you're okay with the potential tax hit, you have the savings for having to pay the additional taxes, then let's go for it. But if it's like a substantial amount, you're not in residency, you're in your higher income earning years, that's where maybe this other option of doing kind of a backwards, a reverse rollover back into a current employer account. So let's say you have a 401k with your current employer or a 403b with your current employer, and you've got, let's say, like $100,000 in IRA assets that was from an old employer a long time ago. But now you're thinking, I want to do backdoor Roths because I've run out of money I've run out of space to put into my current 401k plan. I want to be able to contribute to a tax preferred bucket of some kind, and the Roth IRA is the next option. Well, we've got to fix that $100,000 IRA problem. So options are, you can take the money out in cash. Don't do that. We can do a conversion, but that 100,000 being taxed as income this year might hurt if we're in like the higher tax brackets already. So then what you can ask your current custodian is, do they accept roll-ins of an existing IRA account? And if they do, then you can roll that traditional IRA that you have, the 100,000, you can roll that into your employer account. Now it's within the 401k shell, which is not going to be subject to that pro rata rule. So those are some options that you can strategically think through. And it might depend, someone might decide, hey, I'm just going to rip the Band-Aid off and pay the taxes on the 100,000 now, do the conversion. But others might like that reverse rollover option to go back into the employer account to avoid the tax.
I'm going to add to that. Like, I don't know about you guys. I feel like I grew up in a generation where like we used to like actually pick up the phone and call. So you're kind of saying like, yeah, call your custodian. But I know we have some folks, Gen Zers are notorious for not wanting to do that. So I'll drop a little pro tip. You don't have to talk to anybody. You can find a document called the SPD, or summary plan description. This is basically the rule book of your 401k plan. So if you find this document, it will say in there whether or not rollovers are accepted. And if rollovers are accepted, then you're good to go. Then you might still need to reach out to a person eventually. You can't hide forever, but at least this way, can you do this strategy? I would say about 70% of 401ks do accept rollovers. So there's a good chance you can get away with this strategy.
Yeah. And even if you maybe have one of the bigger firms now, like let's say as your kind of custodian, whether it's Vanguard, Fidelity, TIAA, right, you're always going to have, especially your plan might actually have someone assigned to it specifically of that institution. So it doesn't hurt to, if you don't want to call necessarily just the customer service line, it doesn't hurt to maybe reach out to HR to see like, hey, do we have a rep from this so-and-so firm that works with people of our employment that can help me understand my options for rollovers? But to actually expand on what Megan said about the reverse rollover, which I'm a fan of too. We have, and I want to kind of build more in scenarios because and this is unrelated to our best friend, pro-rata, formerly known as the home wrecker, but now as Sid calls it, what?
Schmagegi.
Spaghetti. I could never say that right growing up. I was always say spaghetti. But anyway, or I thought it was spaghetti that they were referring to. But I would say so a lot of people, if you've ever had a 401k or a 403b and you've rolled it over outside of that, you might have a rollover IRA currently. And what, a lot of people are like, I don't know the difference between a rollover IRA or a traditional IRA. They're essentially the same thing, but the rollover IRA came from a result of a rollover. Think of it as kind of like it was supposed to be used. It was built as a conduit, in a sense, to go in and out. I bring this up because sometimes when we discover someone needs to do a recharacterization where they move money out of the Roth IRA, their first instinct is, should I put it in my rollover IRA that I already have, right, from my Roth IRA? My recommendation has always been to open a separate traditional IRA. Not that this is going to solve the pro rata problem at all, but it'll help with the commingling problem. So what I mean by that is eventually if you are someone who does want to zero out your accounts and get them over to 401ks or 403bs, sometimes these plans might have restrictions on non-qualified funds, right? Not being pre-tax dollars. They were after-tax dollars that are non-deductible. So by keeping them separate from the rollover IRA, you protect that from being essentially zeroed out. So if you're someone, I've actually had a lot of friends reach out to me this tax season already saying like, hey, everyone told me to do this backdoor Roth, but they didn't tell me to zero out my stuff. What should I do? And I'm like, well, you should work on zeroing out your stuff and getting it over there to those accounts. Right. But in the meantime, open a traditional IRA and start this backdoor Roth process.
I have another way for some folks to try to zero out your accounts. If you have a side hustle, like maybe you're driving for like Uber. I know this is one of my, I have a lot of favorite accounts. I don't know, maybe I need a hobby. I just love all these retirement accounts, but if
you're in the right profession.
I think so. If you have like whatever you're doing, working at Etsy, I don't know, you have 1099 income and you have no employees other than maybe your spouse, you can open a 401k for your business. It's a special kind of 401k called a solo 401k. And because you are the one opening it up, you can create whatever rules you want, which means you can allow rollovers. And so you can create this account. And this is, you know, if maybe your employer doesn't offer a 401k or you don't like their investment options, you can open this account and then roll the funds into that.
Yep, that's a great point. And you work with a lot of folks, Sim, too, that have like moonlighting or like contract work that they do on top of their usual schedule. So this could certainly be an option. Now we still have to pay attention to, like, if you were to want to contribute to the solo 401k, we'd have to pay attention to the aggregate employee contribution limits. But again, kind of going back, you were talking about the solo 401k as like a shelter for this pro rata rule, which we could totally use. But if you also wanted to entertain contributing to this solo 401k, we aggregately can only contribute up to the employee max, the 23,000 between all 401k accounts. But the employer side, that's a different story, right? And that might get into another kind of tricky math equation, but that is something that you can consider making a contribution for on the employer side of your solo 401k. So it also opens up another bucket for being able to contribute more to your retirement. So then you'd have current 401k at work, if applicable. You'd have backdoor Roth going, and then you'd have your solo 401k where you can't contribute necessarily to the employee side if you're already maxing out your other 401k. But you can consider making an employer contribution on that side of the spectrum.
Yeah, to make this even more relevant to some of the populations I work with a lot, whether it's, you know, nurses, therapists, counselors, teachers, right? A lot of these professions, you have your W-2 potential income, right? Where you have that for your either 403B or 401k. But then a lot of these places, especially nurses specifically, could do some per diem work, right? So you might, maybe it's one shift. I have a client that's one shift a month, right? It's 1099 though. And because of that, you know, she could open up a solo 401k, make a little bit of a contribution because it is going to be limited by your self-employment income or gig income at that point. But then she can also use this now as a conduit for pulling over other accounts that she might have sitting around from other institutions she's worked at previously.
Old accounts, yeah. So it's in your control. So that could be a benefit of opening a solo 401k if possible. It's more under your control. You can control the investments a little bit more than what maybe your current 401k provides. Because you have a list of what you're eligible or able to be able to invest in with your current employer. If you have a solo 401k, you might have a little bit more flexibility in what you can invest in, which is nice. So, good stuff, guys. Man, this is all pretty complicated though, right?
Should we make it more complicated? Do we dare mention the mega backdoor Roth?
Oh my gosh, yes, let's get there. Let's go there.
Why don't you just pull the cord there?
Yeah.
Why don't I just go? Okay. So if you really, really, really love after-tax money, there is another way potentially that you can get even more money set aside through this mega backdoor Roth. And so this would be something you do with your 401k plan at your job. This is totally separate, by the way, from everything we just talked about with the backdoor Roth. So you can still do a regular backdoor Roth separate from this mega backdoor Roth strategy. I get a lot of questions about that. With the mega backdoor Roth, you have to have a 401k plan that allows what's called an after-tax contribution. And so if you are able to make an after-tax contribution, which could theoretically be, you know, depending on what your employer has put in, maybe you can do like 20,000 or 30,000. This is for folks who have like the income to do this, right? Not everyone can do this, but you make the contribution and then the plan has to allow either an in-service withdrawal or an in-service like distribution. But then you can take that money that you just put in there after tax and move it into like a Roth IRA, or maybe even like the Roth 401k bucket at that, at your job.
If they have a Roth option too. Yeah. So it's basically doing a conversion within the shell of your employer account. It's just the key is your employer has to allow for it. So I think if you have the ability to do the after-tax contribution, maybe that's step one. And then the next thing you have to figure out, like Sim said, was do they accept the conversion within the account into the Roth option, or the in-service distribution to roll that into your existing Roth IRA on the outside.
And that's where the SPD can come into play too. That little document, summary plan description. I know. I'm like,
Yeah.
let's get literate so I don't have to talk to people.
Not everyone's an extrovert like us. I get it. And so, but one thing to be mindful for too, right? Like Megan said, three things have to go right for that to be able to happen. It has to allow after tax dollars. It has to allow you to potentially do whether it's an in-plan conversion or an in-service distribution, right? As well as it has to have the ability to do Roth dollars, which is more and more common these days in plans. And I think in the last 5-10 years, like 10 years ago, we wouldn't really be talking about, I feel like, mega backdoor Roths as much anymore, as much. But one thing I want to say though, is remember, they're all going to fall, the after-tax contribution you make is still going to fall under the aggregate limit between what you're allowed to do and what your employer can do together. In a year. So remember, just for our folks here that are on the quest to lower their AGI forever, right? For student loan purposes, that even though what we're talking about, it might not be applicable to you at this time, but that's also what the future, I actually, not to get down and dirty here all the time, but like when it comes to contributions, I nerd out on strategy all the time with clients. And sometimes I'm trying to get them in the mindset of like, they are making Roth contributions in their plan. And I'm like, yeah, Roth is queen. Like I'm queen Roth, but like, did Queen Roth have student loans? And so sometimes I'm getting them to think about where they are in their journey. Hey, can we shift some of these Roth contributions over to pre-tax contributions in your retirement plan with work? And trying to get them to see the long vision, because a lot of these plans do have in-plan conversions. So what Sim brought up is that like we're talking about something that is potentially with the after-tax dollars, hopefully going to have limited tax implications, but you can do one that is going to have semi-tax implications. And that's just a regular conversion within your plan with work. So there are people who like, I had a client with Student Loan Planner, I think like a week ago, where we were talking about, she was 5 years away from PSLF, and she probably had another 15 to 20 years of working career left. And so we were saying like, I'm trying to convince her like, hey, get this money over the pre-tax. We're trying to minimize your payments, optimize forgiveness. And afterwards, you have 15 years to do, first of all, Roth contributions. But second of all, you can begin to a strategy, hypothetically, of converting these over time, not all in 1 year, especially if there's going to be tax implications, right? And so that's just one of the many nerdy strategy ways we can do this.
Yeah. Yeah. So that's a great point, because what you do right now, like I think financial planning, like you have seasons in your financial planning journey. And a lot of the folks who we work with now, they're in the season of maximizing their student loan plan, starting to get savings going, getting into good habits. Like pre-tax right now might make a lot of sense for your employer account contributions because of the student loans, but that's a perfect example of how you could talk about the future on like, hey, pre-tax right now makes a lot of sense, but later post-tax might make more sense after the student loans are gone. So once you like implement like an idea or a plan, don't feel like you have to commit to that forever. Like it can absolutely change depending on what season of your financial life that you're in, So I want to mention that because I think a lot of times people feel like scared to commit to something because it's, it doesn't have to be the long-term commitment. But one other thought I had when you were talking about this, so this is getting more into like some student loan strategy. Let's say that you and your spouse both work. Let's say one of you has the student loans and we're trying to minimize the payments to go towards loan forgiveness. And let's say both of you guys are contributing to your employer accounts, pre-tax, let's say, but you're not able, it's not within the budget. We're not able to max out both buckets. So you're doing like, 10% into your account, your spouse is doing 10% into their account. Budget-wise as a family, that's all we can do. Sometimes a good thought process or strategy would be, we're really trying to minimize that student loan payment for the spouse that has the loans. If we're not maxing out that spouse's employer account, it could make sense to shift our savings into the spouse that has the student loans. So let's say the 10% that the non-student loan spouse is doing into their employer account. Let's say we slow that down or maybe just get to the match, and then the match that the employer might be giving them, and we move the other percentage over to the spouse that has the student loans, that has the bigger impact on the AGI, that would have the bigger impact on the student loan payment. So that's something I talk about a lot of times in student loan consultations too. But does that make sense how I explain that?
Depending on how this works, community property state versus regular
Mhm.
non-community property state. But also one thing to note about it though
Yeah.
is there is different strategies with alternate documentation too, even if it is a community
Mhm.
property state. So like there is workarounds, but there's even this is a Pandora's box of different strategy
Yeah.
too.
This is a Pandora's box because also like that also in a way from a like I'm trying to find the word for it, like if a marriage doesn't work out, like that might be a problematic if you like prioritized one person's like retirement savings bucket over the other. You know, divorce is a real thing. It does happen. Like that might be something you want to think about before making that adjustment. I don't know if things are rocky, maybe that's not what you want to do. But is that where you were going, Sam, with that?
Yeah, I was going to talk about the community property thing because there are 9 states that are community property states, and it's a little different there because everything that everyone does to lower AGI, it's like a team effort because what they do is they take all the income and then they just split it in half. So for a common law state, the other, how many states are there? 50? It's one of those days, guys. For the other, for the
41.
other 40 plus states, for the other 40 plus states, I totally agree that it may be strategic to do that shifting.
Well, one way, because normally like when we're doing, in a community property state where they do take everything 50-50, if you are typically the lower earner in the 50-50 split, when you file separately actually raises you up. You do show alternate documentation like a pay stub or a W-2. As much as, and to be fair, if we're using Megan's strategy here, the pay stub is going to make the most sense, but I always have trust issues with how servicers process the pay stub. But
yes.
But in theory, like it still works in community property because it'll still show like your contributions are going towards your pay stub there too.
What I've been telling people to do recently is with the pay stub strategy to attach a cover letter of explanation, because what they might do sometimes is with your pay stub, not take out your pre-tax deductions. So the nice thing about the tax return is they're using adjusted gross income. So they're taking your income, taking out those nice 401k contributions. They're not always doing that because sometimes they're lazy. So they just take your pay stub, pull your income, and that's it. And that's a higher amount. So attach a cover letter of explanation saying, these are the total of my pre-tax deductions per pay period. This is my my after, my adjusted gross income.
And I would make it super clear, like here's my monthly pay, or here's my pay per paycheck, my minus my pre-tax deduction, and I get paid 26 pay periods a year because you're biweekly, or 24 pay periods a year because you're semi-monthly. Like that's important too. Like the calculation of like how you annualize your income does matter. And you are likely going to do that calculation correct over like what the correctly versus what the servicer is going to do. So rely on yourself, self-advocate, make sure that they are using the adjusted gross income portion of your income and that they're calculating it based on like how you actually get paid over the course of the year.
I don't know how many times you guys say self-advocate in a week right now to clients, but I say it a lot. But anytime you're showing documentation, or at least alternative documentation, always doesn't hurt to throw in a love letter. You literally walking them through the equation for them right now.
Right.
But now we've gone down this hole from starting about our loves for Roths to all the way through contribution strategy. So it is not to sound like a broken record here, putting in a Pandora's box of different strategies.
Yes, there's a lot. There really is a lot. And I think, when there's this, I think finance is also like super personal. Like everybody's situation is so different. We talk about on this podcast a lot that everybody's student loan plan is very different from one another's. Like there's not a cookie cutter plan. And there's a lot of factors in your personal finance life or your family that is going to make your plan different than your colleagues. So a customized plan could be really helpful. Of course, that's what we do with Student Loan Planner. We could definitely help you out with your student loan strategy. And people make mistakes. There's a lot that goes into all of these little like maximization strategies for saving money. Like I'll pick on myself, actually. Y'all will laugh at me or maybe get mad at me. I don't know. But I was talking to someone earlier today. They do not have an employer plan. So they were contributing to an IRA, but they're filing taxes separately. And right off the bat, I panicked for a second. I was like, oh no, your IRA is big. Like we have Roth money too. Like we should probably be doing a backdoor Roth because y'all are filing separately. And like totally over my head for a second, I didn't realize, oh crap, they don't have an employer plan. So there's no limit on how much you can contribute to an IRA and get the deduction. So like I had to go to the IRS website, double check it, like put my eyes on it, and then tell them like, oh, I was wrong. Sorry to panic us. But like this stuff is confusing. And like there's so many like little details that go into like your plan that having like someone on your team that can just help you sift through those things and also check yourself, right? Because everybody can get it, needs a check sometimes, like me today. But
those
that's what
those pesky active participation rules.
I know,
what
gosh. Yeah. But that was an interesting thing this morning. It definitely humbled me a little bit where I was like, you know what? Everybody can miss stuff every so often and like forget one little technical rule about a plan and then have to go back and rework something. So
I think it's just the season of like, especially like right around right now, we're seeing it, I think, more day where over the last 6 months, we were proposing to people as payments were restarting, like, hey, you're looking at people, a lot of people filed jointly the previous year because of COVID, that they're now filing separate this year. And so because of that, we've always uncovered some like, oh, you have to, before you do this. And I feel like it's because we do feel a sense of responsibility because sometimes people, these are your do it themselves people. And they're also sometimes we're referring them to go to their practitioner who might not be up to speed on, why they're filing separately from a student loan perspective. But then we're seeing a lot, like we recommended on the student loan planner that they file separately and then they become like an SLP wealth client. And then suddenly they have to, now we're helping them do the recharacterization, right? The Roth IRA.
Yeah. Yeah. So that's another thing to mention too. Like we, of course, do student loan planning, one-on-one consultations. We'll build you out your customized plan. We'll triple check it. We'll send you that recap before we send it. And or before you implement your plan. And then you have access to us for questions. But a lot of times our clients will say, well, what's next? Like we tackled our student loans. We kind of dealt with the elephant in the room. What can I do about this backdoor Roth? How much should I be saving for retirement? I really want to buy a house. Like, how can I get there? So that's why we started SLP Wealth. That's kind of the next step in progression. If you're interested in more comprehensive planning, then we are super happy to help you like with your other goals that you have now that like the student loans are checked off. And if you need like a teammate to help you really with the rest of your finances, we could be there for you on the SLP Wealth side.
And also know what T's to cross, I's to dot, and especially with reporting, right? Or even like not necessarily like fixing past issues, but how can we go forward and continue to make sure you don't have to have some sort of like resolution, right? But also, I don't know if you can tell by Sim, working with someone who actually really loves what they do too.
Right.
Let's get down to these Farkakta rules. That's my next Yiddish word, Farkakta. These Farkakta rules. I love knowing them. One more thing I'll add is that based on feedback, we do have profession-specific planning as well. We probably don't have like every single profession out there, but we have a lot of the biggies, and we're adding more all the time. So we have, physicians, dentists, nurses.
Sorry,
I'm looking at Sam. I'm like, PA.
No, I saw like for me,
physician
like for example,
assistant,
like
thank you.
So Sim does physicians, right? I work with PAs, nurses, but then because I have a background in working with people in higher ed, so teachers, professors, and also people who might be in more like nonprofit work such as social work and counseling.
We have attorneys, we have lots of groups. And, if you reach out and you feel like, hey, I'm in this group and we don't have one, let us know and maybe we'll start it.
And I think it doesn't like kind of like to make a point of how this came about is that because we are, and not to say that this is going to be forever, but we have had a history and a trend of working with people who have student loan debt, right? And so there are certain professions that require, right, that going to that graduate school, going for a certain amount of years, and people just due to the nature of their profession and occupation that they are going to have student loans. And so we've gotten more, the way we've split these groups up is because we've noticed certain trends or strategies that are going to work specific to kind of where we see a career for this industry working out.
Yeah, it helps with getting more specific with planning, with the, the education behind like, what are you going to run into in your career? Like in the dental practice group, like they run into folks who are looking into buying a practice all the time. or partnering, or comparing a loan option for purchasing it. So like there's a lot of little specific things that each profession tends to go through on their career journey and on their money journey too. Like as they earn more money, make more money, start families, like there's just a lot of things that might be specific to that trajectory that I think the planning groups help with. But this was fun, guys. This was a lot of fun. I always enjoy doing podcasts with you. Anything we missed or didn't mention before we hop off?
I'm sure we could talk about this for hours, but no,
I think
we've done enough damage for one episode.
Yeah. Yeah. I hope listening, you were able to take a couple nuggets, identify if you've made some of these mistakes, and also identify how to fix some of these things before it's too late or before their fees get too high, right? And if you need the additional help, we're here for you for the student loan consultation and or the financial planning conversations, pulling all these pieces together, making sure your whole plan is cohesive and everything's talking to one another, going towards the same objective. So, but thanks for hanging out with us today, and catch us at studentloanplanner.com. If you have any questions, shoot us an email, help@studentloanplanner.com, and we'll catch you on the next one.